Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, after 2 days of deliberations, the OPEC and the allies have announced a sizable 1.2 million barrels per day of cuts. The cuts will last for 6 months and will be reviewed, though, in the month of April 2019. The OPEC in this deal will cut 800,000 barrels per day and the non-OPEC will cut 400,000 barrels per day. Within this, of course, in the allies, when you look, it really is about Russia, Oman and Kazakhstan. So Russia definitely gets more than half of those cuts at 228,000 barrels per day. The crude oil prices have closed the week more than 2% higher after the deal announcement is done. Remember, the crude oil prices have plunged 30% since the month of October, since the supply surged and the global demand growth has continued to weaken. The output from OPEC, Russia and US has increased by 3.3 million barrels per day since the end of 2017 to 56.38 million barrels. That clearly is 60% of global demand that we are seeing right now. So these three major producers is something that you really need to keep an eye on as we get into 2019 as well. But first up, let's hear out the key announcements from the president of OPEC, Suhail Mohammad Al-Mazroui. Let's listen in.
We are proud of, first of all, of our partnership with our friends in from the non-OPEC. The number of countries of interested countries and observers are increasing, which is a good sign. We mentioned that OPEC group is contributing 800,000 barrels per day as a cut, and the non-OPEC will be contributing 400,000 barrels per day. We have agreed and initialed the Charter of Cooperation to be used as a draft for the next stage of finalizing it. We will be forming a drafting committee to deliver the final draft by the first quarter of 2019.
All right, so what is really awaited even now after that announcement is that the first final draft of this will come in by the first quarter of 2019. So there still is a lot desired that we have seen come in from this OPEC and the allies meeting. Remember, it was the OPEC meeting, the 175th meeting between OPEC members, which actually concluded without any announcement as well. And the second day, that was yesterday, on Friday rather, that we saw the OPEC and the allies come together and continue deliberations for much longer than what the timeline really was. But at least what we have on plate right now is the 1.2 million barrels per day of a cut. What it has been in sense of quotas being assigned to various members is something that is still not clear. And as the OPEC president himself was saying, that the final draft of this would only be made available to the world by first quarter of 2019. Let's get analysis done on that then. And Paul Hickin, Associate Director of Oil at S&P Global Platts, now joins us. Paul, thank you so much for joining us. What is your sense? Because clearly the two-day deliberations were anything but easy. We clearly have seen a discord between the OPEC members. How much would you say that it has been difficult for the OPEC members to come to that number, especially given that there has been pressure from the US president and Russia clearly came on board much later?
For certain, it started off bad with Qatar pulling out, and it looks like it's quite acrimonious right now as well. You've got to remember though that these are all producers which are competing with each other for market share. These meetings, everyone is trying to get the best deal for their country out of it, but at the same time recognise that a deal is necessary for everyone to benefit ultimately. And it's that brinkmanship which is being pushed to the limit this time. Iran pulled it off last time, 2 years ago, when they got a special relationship, not exactly exemption, but it got a special deal. And it looks like they're really pushing hard for this time, given they've got sanctions around them again, and they're not going to have the same production limits that they had throughout the deal. So it's really pushing it to that brinkmanship, to the wire.
So, Paul, what would you say? I mean, with the kind of meeting that is just concluded, does OPEC still get it, have it, or is it the US production increase that will continue to weigh into the global markets and, of course, weigh on to the OPEC and the allies' market share as well?
Well, there's probably two things going on here. First, you've got to remember that the type of crude that the US produces is different to a lot of the OPEC crude, which is heavier and sourer. The US crude is lighter, sweeter, and there's often different markets for this crude. But at the same time, the extra barrels coming on from the US is a problem for the oversupply of the market, looking like 12 million barrels a day. And it's a very different situation from this time round to last time. 2 years ago, you had a big stock overhang that had to be cleared. This time, the stock overhang isn't there at the moment. But at the same time, last time, you didn't have the same level of US shale and US production being exported as you do this time round. And once the debottlenecking clears in the second half of 2019, that's going to be an extra issue, an extra challenge for OPEC to overcome. And that's going to be something they've got to really try to factor in the first half of next year, where this is their opportunity.
Paul, what is your sense? Because when you look at this deal on what the communique really has been from the OPEC and the allies, it just says that these cuts would be carried on for the next 6 months, but it would be reviewed in the month of April 2019. So we really are looking at a quarter-on-quarter basis, and the cuts itself would begin only from the 1st of January. So that means there is going to be increase in supplies, as much higher production for the month of December to go on as well. And we are looking at record high production from OPEC, from Saudi Arabia, that is, from Russia, from the US as well. So how long would the output cut really be required to ensure that the supplies are reined in? Or even with the 1.2 million barrel per day of a cut that we are seeing right now, you do see the glut in the global markets continue?
Well, I'm surprised with these kind of limits on these production cut agreements, because OPEC has always been continually reviewing its deal. It's continually changing policy. It meets regularly. They've had the JMMC meetings. They have regular dialogue. Just a few months ago, they changed the terms again, where Saudi Arabia and Russia and UAE all producing at record highs according to S&P Global Platts survey. They've already changed the terms quickly in September, October time. So they do change. So if you're looking at what time that they put on this deal, this is kind of for their own internal dynamics in terms of what's acceptable to certain members about how long it lasts for. But realistically, it's a continually evolving thing. They're looking at the market, looking at how stocks are going, how much US supply is coming onto the market, what's going to happen with Iran's sanctions waivers, whether they're going to be this zero tolerance in the spring after the waivers end, if that's likely to be happening.
Well, absolutely, Paul. Thank you so much for joining us. That really is the view coming in from S&P Global and Platts. Then they feel that the markets will continue to see higher supplies going forward, and it really is going to be about Russia on how bigger a role that they will continue to play in this whole deal. Joining us now, of course, is Miswin Mahesh. He joins us on the issue of Russia, really. Miswin, thank you so much for taking your time out. What is your sense? Because clearly the two-day deliberations ended only after Russia came on board and came in with a major chunk, a bigger chunk of nearly 2 million, rather 0.2 million barrels per day of a cut coming in. What is your sense? How important an ally will be Russia when you look at for OPEC and for the global markets as well?
I think Russia is certainly the glue that's binding all the other producers at the moment, especially given how the first day of the OPEC meeting, they themselves couldn't really come up with a solution themselves. They had to bring in Russia to really broker that deal. And I think that really highlights how with Russia producing 11 million barrels per day, around that level, has a very powerful alliance with the rest of OPEC. As you said, I think in terms of Russia actually cutting those barrels, it looks like they'll only be able to cut those barrels in the spring, which is from April, whereas the market needs those cuts right now. And there's quite a lot of uncertainty going into that April-May period as well with regards to both US shale and the Iranian sanctions. So Russia would be beginning to cut when the market may very well be in a very different state as well. So that's something Saudi Arabia and the rest of the members will be trying to bridge.
Miswin, as we were discussing with Paul as well, and he said that almost all these oil producers are actually competing with each other. But one output producer that we actually missed to talk about really is Canada, and they have committed to an output cut by 9% in 2019. How big does that number look to you? How committed would you say Alberta really is going to be on this? And would this actually put any impact on the prices going forward?
Yeah, I think the Canada one has been overread quite a bit, the headline number of 350,000 barrels per day. In theory, it's a lot less because these producers have been operating well below their break-even, and they've been cutting even on a break-even basis already. The only thing that's happened is the government of Alberta has given a voice to those collective cuts and called it 350,000 barrels per day. And we need to remember this. There's a monthly assessment that's going on as well. And the Alberta government has said once the inventory levels, local inventory levels go below a certain level, they'll start trimming those numbers as well. So it's not like it's going to be 350,000 barrels per day for every single month of 2019. It's going to be a much less number. And as per my balances, it's roughly going to be 150 or 200,000 barrels per day, at least for the first quarter of next year.
Oh, well, that's absolutely not very impactful if that is the number that we actually might see coming in from Canada. But, Miswin, let's talk about the other global cues. And it really has been about higher supplies, but it also has been about what OPEC actually would do going forward in 2019. It also has been about the US Fed. While we are preparing for an interest rate hike for the month of December, there perhaps are more coming in 2019. And then, of course, there is the global trade tensions. There is this China concerns about slowdown, the Chinese yuan itself, the currency play. How have you, factored in an impact on crude oil prices from all of this?
Be a ceiling for oil next year if it weren't for the supply side in itself. And I think that demand slowdown is something that we need to be conscious about for next year, even with the OPEC cut. On prices, I think what OPEC has now agreed doesn't really cause a rally in oil prices. It more so puts a floor for oil prices, is what I believe that they've managed to do. And I think that's probably a solution everyone's happy with, given the economic environment we're in at the moment.
So, Miswin, let's talk about the prices then. And of course, we have seen them very, very volatile. The last whole month, it has been between 2% to 8% on the higher side as well on the day. We've seen Thursday and Friday actually see 5% of moves as well. At this point, of course, it is about the US rig count as well, which has seen a decline, which has been supportive for the prices. But what is your sense? I mean, we closed Friday with nearly 2 to 3% of gains. For the first week of December, we actually are leading with 3 to 5% gains, depending on which crude variety you are talking about. But given the kind of circumstances that we have right now, with a lot of uncertainty as we get into 2019, what is the price range that you're working with?
So my base case scenario is that Trump will go very hard on Iran once the first bit of sanction waiver window expires, whether it be 90 or 180 days. Things will start to tighten then from the supply side. But the issue again is on the demand side, I am quite bearish. So we might have a situation where these things offset. So there's a slowdown in Iraqi or a slowdown in demand, but also supplies being cut from Iran. And if anything, to bridge the gap, there'll be US production as well. So I think on the whole, all of these big factors can balance themselves towards a price around $70 a barrel is what I'm thinking for at the moment.
All right, $70 per barrel as average for the Brent prices in 2019 does seem like good. Thank you so much, Miswin, for taking time out for us and analyzing what the OPEC and the allies really have done over their very important meeting. Well, as far as the prices go, we have seen various views come in from the global experts. Citibank, of course, has talked about $57 per barrel as an average price. And then, of course, you have ABN AMRO, which has talked about $90 on the higher side as well. But as the consensus really seems to be building in, it is around that $70 per barrel mark that most experts really are working with. We also spoke with Azleen Ahmed, Argus Media, and asked her about the global oil demand and supply numbers that she's working with for 2019 and also her price forecast for the same year.
I think that the demand numbers right now is a little bit uncertain. Our expectations was that the demand in 2019 would definitely be lower compared to 2018 mainly because of the impact of the US trade war with China. The demand figures are a little bit vague because it just depends on to what extent the US will continue with this trade war or whether it will pull back and there will be some sort of agreement, settlement with China. I think that's quite key to where the demand growth is expected to be, at least in the first half of 2019. I think the expectations and the general expectation from the market is that, let's say OPEC, I think that if OPEC agrees to cut 1.5 million barrels per day, we could see Brent prices go up to $70 quite quickly. If OPEC and its allies agree to a 1 million barrels per day cut, I think that we'll see prices at the moment fairly steady, but going up slowly over the next few months to at least closer to $70 towards the end of the year. So I think roughly we're working on about 60s to low 70s kind of level for ICE Brent.
Well, absolutely. That's yet another voice telling you that $70 per barrel of an average price in 2019 is what you can expect to work with. But with that, let's slip into a short break. On the other side, we'll get you a chat that Parikshit Luthra had with the United States Under Secretary of Energy, Mike Menezes. Stay tuned.